The market is spiraling downwards. Bond yields are surging. Job openings just topped 9.6 million, meaning the Fed will likely continue to move very hawkishly. Oh, and Kevin McCarthy was ousted, which isn't that big of a deal for you or me as investors, but it certainly adds to the mix of uncertainty, giving way to more fear. Now, why do I share all that? Because there's really one investment solution for all of our problems right now: SCHD, or for those of you not too familiar with it, the Schwab US Dividend Equity ETF, which is down by, get this, nearly 8% on the year, trading for under $70 per share at $69, which is way off its peak of around $78 per share earlier this year. So how about we talk about SCHD? If you're a dividend investor, why it not only needs to be in your portfolio, but should be the one investment you're doubling or heck tripling down on right now. So first, let's just set the record straight. When it comes to why you actually should consider an exchange-traded fund, or an ETF for short, it really doesn't get any more straightforward or simple than me just sharing that investing into a basket of stocks, which is exactly what an ETF allows you to do, gives you with maximum certainty and security that really, as an investor investing into the stock market, you'll want. Now, essentially, it's about tracking the broader market. And if you're tracking the market itself, you cannot lose. I mean, it's literally a fail-safe strategy. Now, ego may actually tell you that you can invest like Cathie Wood or Michael Burry 100% of the time. But recognize that wealth over time, or simply just not losing money, is better than gambling, because even Woods and Burry get it wrong more often than not. Which leads me to SCHD, a passive income seeker's dream, as it tracks as closely as possible before all fees and expenses the total return of the Dow Jones Dividend 100 Index. So in other words, tracking quality and sustainability, with the prereq being each holding must pay a dividend and have a track record of dividend success. Now let's explore SCHD's fund profile here to uncover some pertinent information. I want you to first take note of its date of inception, or the date it was established back in 2011. Now, I also want you to take note that it nets over $46 billion in total assets, with a total of 105 holdings, with the top holdings being our healthcare leader Amgen, followed by another AbbVie, before an energy leader Chevron, along with another healthcare gem here with Pfizer, the soft drink manufacturer and behemoth Pepsi, with Merck, Cisco, Texas Instruments, Verizon, and Broadcom, all on the come up as well. Now, what do all of these stocks have in common? Well, all 10 are industry leaders with a great reputation, strong management teams, and most importantly, healthy balance sheets with little to no debt, which all allows these companies to continue to deliver consistent dividends to shareholders. Now, SCHD has 95 more companies just like these dividend stocks to ensure plenty of dividend growth for you, no matter what the economic environment is. As we can see, the fund has plenty of reliability, with industrials making up about 18.13% worth of the stocks within SCHD, followed by more safety given the healthcare holdings making up about 15.6% of the fund, before the holdings turn to financials making up about 14.54% worth of the fund, which gifts all of us with a beautiful dividend yield coming in at 3.83% as of this video. And better yet, if we jump over to Seeking Alpha quickly, we can see that SCHD has a 5-year growth rate of 13.69%. It's been growing for about 11 straight years, giving way to an annual payout per share of $2.62. But now let's get back to Charles Schwab here, as I want to direct your attention to the fund's performance. And as I get to the SCHD's performance, recall how I shared it was founded back in 2011, so we can actually go back 10 years to see just how much $10,000 invested would have made us. To which we can see here, $10,000 invested would have resulted in about $18,582 back in our pocket, assuming we have reinvested all of the dividend gains and returns, which is not too shabby considering we've had plenty of volatility since 2011. And if investors over the course of the last decade could have invested confidently into SCHD, I think we all need some faith to follow suit right now. I mean, literally, at any time, we can actually take a look at the gains over time when it comes to SCHD. We could see over 172.56% worth of growth since inception. Now, you may be asking, what's the catch? Is this too good to be true? That's a great question. And a matter of fact, no, it's not too good to be true. You see, for just a small expense ratio here coming in at 0.06%, that totals about $6 per $10,000 invested. Now, that's a steal. And in my opinion, this is the one fund that every dividend investor should be loading up on, especially now with all of this fear creating a discount opportunity for us dividend investors on SCHD. But now I want to ask you, what exactly are you doing as a dividend investor when it comes to SCHD? Because it's notching down closer and closer to this 52-week low. Are you buying? Are you selling on baseless fear, or just holding tight to enjoy the dividends until we bounce back into greener days? Comment down below to let me know, and of course, be sure to subscribe to never miss a single video.